I recently ran a test depositing $100,000 onto the Anchor protocol. This earned me $1,700 in 30 days, a near 20% return doing nothing. I mean, who am I, the Oracle of Omaha? Needless to say, I was hooked. This is one of the greatest things to ever happen to the average investor. Finally, we can get returns typically reserved for the big guys. That is until my dreams of turning 100K into 3.5 million were completely crushed. See, the strategy is falling apart. The Anchor protocol is burning an insane amount of cash, 3.8 million a day to be exact. Here's my math. At this rate, they'll completely run dry in about 50 days. Here's how much money they have left. Every few seconds, this stockpile drops, taking us farther and farther away from easy passive income. Maybe this experiment is just unsustainable, a pipe dream in the world of crypto. Or is there a silver lining? I've done some research, and there just might be. But we need a solution fast because time is literally running out here. See, the Anchor protocol is backed by a crypto project called Terra with their coin Luna. Luna has increased by more than 100x in just over a year. This is thanks to the excitement around their lending program, which is no surprise. But other projects have taken notice. I mean, who doesn't want to 100x their price? That's the fast track to becoming a billionaire. Because of this, we have a few new kids on the block attempting to offer these extremely high returns and make it sustainable, attempting to solve this very problem. Just maybe one of them will figure it out and create the investment opportunity of a lifetime for all of us. By the way, making money is just one side of the coin. No pun intended. You can save it as well. So check out today's sponsor, iTrust Capital. With iTrust, you can place your crypto in a Roth retirement account, allowing you to invest and trade crypto, all without having to worry about capital gains taxes. If you use the link in the description, you'll find additional information as well as receive $100 in Bitcoin free for joining. Now let's get into the juicy details because there's a new player entering this space, taking an interesting spin on the sustainability of this entire model. This is the Near protocol with their newly launched USN stablecoin token. This token, like Anchor Protocol's UST, it's what's called an algorithmic stablecoin. Some people love these things, other people hate them. A stablecoin is simply a coin that is pegged to the US dollar. Traditionally, these are backed one-to-one with a dollar in a bank account somewhere, at least they're supposed to be. An algorithmic stablecoin uses crypto assets to back the token, ensuring that it's worth a dollar. Then, individuals are allowed to profit off of small fluctuations in price by buying and selling the token, keeping it right at $1. This works, except if there's some kind of doomsday event. If the crypto backing a stablecoin collapses in price, that algorithmic stablecoin can fall off the $1 peg. This is bad if it doesn't recover. But these types of stablecoins are gaining popularity after the massive success of UST, that token that I used on the Anchor protocol. So for this new option, you would buy Near tokens and then swap them for USN stablecoins, essentially locking away your Near for the USN digital dollar. This is where Near is doing things a bit differently. See, the Near token is stakeable. You can lock it up for an 11% return. So the USN stablecoin token will use Near staking to help generate a return of a minimum of 11%, according to their documentation. But there's more. Due to additional incentives, the first people to lend out the token will receive 20% plus APY, beating out even Anchor protocol. This is amazing, but I do have concerns. Seem a bit of a stickler, and two things stand out to me. Let's go back and look more closely at the line talking about USN rates. Quote, at its lowest, it will be equal to Near's staking APY, currently about 11%. Everywhere you look, you see that 11% minimum figure, but this isn't taking into account how staking works. The cash you receive from staking is based on token price. So let's say a token is worth $100. You have one token, you stake it at 11%. After a year, you get $11. If that token cuts in half to $50, so does your return from $11 to $5.50, even though the APY is still 11%. So if the base return is determined by staking rates of Near and the Near coin dramatically decreases in price, so would the return. This, of course, isn't counting any of the additional incentives that they plan to layer on top, but we don't have all that information yet. But I saw no one talking about this, so I went into their Discord to ask, and after some back and forth, yes, it's possible that the rates could be less than 11%. Now, this is totally fine because thanks to other incentives, it'll likely be higher than that, but the key is we shouldn't think of the rate as a guaranteed 11% minimum. And this is where I ran into another problem. This line. The stability of the design of USN means worst case scenario, decentralized bank could buy back the entire amount of USN ever issued. This doesn't make sense to me. And the fact that I'm running into concerns at all is a bit stressful. Anchor's running out and we need an alternative fast. For context, they have a reserve that will act as the bank account backing their stablecoin. This will be front-loaded with about $1 billion and double collateralized initially. Future stablecoins are then minted by depositing Near tokens. But remember, the Near token can change in price, so what's the problem here? It's the fact that it says worst case scenario they can buy back all stablecoins with the reserve. That just doesn't seem accurate to me. It seems to me worst case scenario would be their initial seed funding is removed, which they can definitely do because they don't say it's going to be there forever, and then the Near token drops in price by something like 80%. If that happened, as far as I can tell, there wouldn't be money to buy back every token like they say in the worst case scenario. Now, this isn't really an issue because we have that risk with all algorithmic stablecoins, and I'm not saying that this kind of thing would even be likely to happen. It's not likely at all. But what bugs me is saying worst case scenario, but then explaining something that doesn't appear to actually be the worst case scenario.
So that's an adorable worst case scenario.
Just give the facts and then let people decide if the risk makes sense for them. That's all I'm asking for. Again, I messaged them on Discord and it appears more documentation will be coming out on this, hopefully to clarify these issues. But maybe you're thinking, okay, I'll just hold off for a while on this one and see how it goes before aping in. The good news is we have a secondary option, another competitor to Anchor Protocol. And this one promises even higher returns. This is through the launch of USDD, or as I'm going to start calling it USDD, because why not? USDD is a new algorithmic stablecoin built on the Tron network. Now, believe it or not, Tron has some experience with stablecoins. The majority of the world's largest stablecoin, USDT, is hosted on the Tron network, $41 billion in value to be exact. Tron is also the 6th largest cryptocurrency by total value locked on the platform. So this move makes a lot of sense for them. Much of how the USDD stablecoin works is similar to UST and USN, the same methods to keep the price right at $1 and a similar mint and burn process. What's interesting is the rates they plan to offer. 30% APY, more than 50% higher than anyone else. This is directly from the Tron founder, Justin Sun. Let me just show you how insane that is. Remember how I said 100K would have turned into 3.5 million with Anchor's old rates? Well, at 30% APY, that same 100K would result in over $18 million. You just gotta love compound interest. But let's get back to reality, because the odds of those rates staying at 30% for 20 years are pretty slim. Nowhere does it say the rates will be 30% forever. According to their white paper, rates will be 30% in the outset. So realistically, we can't bank on that for the end of time. What's interesting is Tron's goals seem to be even larger than offering a stablecoin with exceptionally high returns. According to a Medium post, they're aiming to create this kind of decentralized central reserve. And that name's a bit of an oxymoron, but basically they want to create a $10 billion fund that will not only act as a reserve for the USDD token, but also help with crypto market panics. Now, this does leave us with 2 questions and a concern. First, in order to build the $10 billion fund, the Tron team will need to get the crypto world to buy into their idea. That's a lot of money to raise, and it hasn't happened yet. Second, this 30% interest rate is extremely exciting. However, nowhere in the documentation does it outline where this money will actually come from, at least yet. So I can't really judge the mechanics on how this works or just how sustainable it might be. Now for the concern, Justin Sun. He's no doubt a force in the crypto world. However, many people aren't big fans of him due to some questionable business decisions in the past, like the fact that the Tron ICO happened in China a few days after ICOs were completely banned, or how an employee of his said, quote, he was doing so-called market making, insider trading all the time, referring to the Tron coin TRX. Or maybe the time he purchased the crypto exchange Poloniex and enacted Operation Couch Cushions. This one's crazy. It turned out the exchange had this odd architecture, and occasionally customers' crypto would get lost within the software. This built up over time. Justin had engineers dig around and collect the missing crypto, about $20 million worth. That crypto was then sent to an anonymous wallet and then back into the exchange's communal wallet, never to be traced or found again. And this is really just the tip of the iceberg. Let me know if you think I should make a mini doc on this guy. It's a crazy story. So it's a sticky situation, but realistically, if you get some USDD tokens and start earning 30% on it, what power does he have over those tokens? Not much, but it is good to know what the founder has been into in the past before you go ahead and ape into something like this. Meanwhile, Anchor is still losing its reserves minute by minute. So what do? What happens if Anchor runs dry? Will we be left with nothing, no solid opportunity? Since the start of this video, Anchor's reserves have lost $29,970. This won't last long. Well, the good news is we'll be fine. Anchor will continue to lower their rates until either the market picks up or they stop burning so much cash. At minimum, this would be in the 7 to 12% range, which is still a great return, especially compared to like a bank account. For now, I'll be sticking with Anchor and just seeing how things pan out with these new kids on the block. People are taking notice of Terra's success and replicating the strategy. This competition will only be good for you and I. The competition only means products, safety, and rates will get better over time. We might just have to be a little patient with the technology. This is still the most exciting time in history to be an individual investor. The opportunities are literally endless. If you'd like to better understand this wild world that we're in, I would highly recommend checking out my Patreon community where we do free coaching every single day on crypto, stocks, and NFTs, and a whole lot more, as well as daily trade signals and the best investor community on the freaking planet. Just make sure you grab a spot in the description. I'd like to thank you so much for watching. I'm Max Maher, and I hope you have a profitable day.